Hello investors, it's Zil from Equitymaster bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and the latest developments on Indian markets, don't forget to subscribe to this channel and like this video. Stock prices across India's market leaders have raced ahead over the past 2 years, leaving investors wondering where the next opportunity might lie. The Nifty 50 has climbed more than 30% in that period, with mid-caps and industrial names outpacing even that. Earnings momentum, steady domestic inflows, and confidence in policy continuity have all contributed to the surge. Yet, this very strength has made valuations expensive across much of the market. At these levels, many frontline stocks trade well above their historical averages. Finding fresh value, therefore, means looking beyond the obvious winners and paying attention to companies whose share prices have soared enough to make a stock split increasingly likely. A split, after all, does not change fundamentals but often signals management confidence and improves liquidity by making shares more affordable. From engineering and autos to electronics manufacturing, several industry leaders now fit that profile. Their share prices have multiplied, face values remain above rupees 1, and the rally in their stocks has renewed chatter that a split could be on the horizon. Here are 5 companies that may consider a stock split in 2026. Before we move on, please note this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. With that disclaimer out of our way, let's get started. First on the list is Dixon Technologies. Dixon Technologies manufactures a wide range of electronic products for leading global and domestic brands. It plays a crucial role in India's electronics manufacturing drive with capabilities spanning mobiles, consumer electronics, lighting and appliances. The stock has been on a strong run. It has gained around 9% in the past year, pushing its share price to one of the highest levels, close to 15,000 in the contract manufacturing space. That kind of rally often prompts talk about a potential stock split, especially when the stock trades well above its long-term median valuation and the face value at Rs 2 leaves room for another division. Dixon Technologies has already gone through one split in 2020 when the face value was reduced from 10 rupees to 2 rupees. Since then, the price has continued to rise. This is a direct result of sustained earnings growth and strong market positioning. In the September quarter, that is quarter 2 of FY26, the company reported a 29% year-on-year rise in revenue led by robust growth in mobiles and networking products. EBITDA margins improved on account of higher capacity utilization and better sourcing efficiencies, even as demand in televisions and refrigerators remains subdued due to the GST rate adjustment. Going forward, Dixon Technologies plans capex of about 3 billion rupees over the next 3 years for its components and display module expansion. The spending will be funded mainly through internal accruals. Given the sharp price appreciation and face value of Rs 2, the stock is among the stronger candidates that could consider a split in 2026. At current levels, the stock trades at a PE of about 13.8, in line with its 5-year median multiple of 14.2. Next on the list is Siemens. Siemens provides automation, electrification, and digitalization solutions across industries, railways, and infrastructure. The company's portfolio spans digital, industrial, smart infrastructure, and mobility, giving it exposure to India's public capex cycle and private sector modernization. The stock is down over 10% in the past year. The stock trades at around 3,000 rupees, well above its long-term median valuation. Investors have begun speculating about a possible stock split given its high price and face value of Rs 2. The last time the company underwent a split was in 2006. A 5:1 split in June 2006 aimed at improving liquidity. In the June quarter, Siemens reported a 15.5% year-on-year revenue growth, supported by healthy traction in its smart infrastructure and mobility segments. EBITDA margins stood at 12.4%, lower than 13% a year ago due to normalization in digital industries and higher material costs. Despite margin pressure, the company maintained a record order backlog of 414.6 billion rupees, up 7.2% year-on-year, underpinned by electrification, automation, and rail projects. Looking ahead, Siemens plans to sustain capex in vacuum interrupters and gas-insulated switchgear technologies, along with mobility product expansion. These investments will be largely funded through internal accruals. Given its strong fundamentals, elevated share price, and face value of Rs 2, Siemens could be among the large industrial stocks that could consider a split in 2026. At current levels, the stock trades at a PE of 65.4, a premium to its 5-year median of 47. Third on our list is Maruti Suzuki. Maruti Suzuki is India's largest car maker with a wide product mix across hatchbacks, sedans, SUVs, and CNG vehicles. The company has been reshaping its portfolio towards premium and utility vehicles while expanding exports and capacity at its Kharkhoda plant. The company has surged over 42% in the past year, driven by robust exports, a shift toward high-margin SUVs, and sustained earnings growth. It currently trades near 16,000 rupees, and with a face value of 5 rupees, investors see Maruti as another candidate for a stock split to improve liquidity. Meanwhile, the business continues to perform relatively well. In Q1 of FY26, Maruti's revenue rose 8.1% year-on-year, aided by stronger exports, even as domestic volumes were flat. EBITDA margin stood at 12%, down from 14% a year earlier due to adverse commodity prices, forex movement, and initial costs linked to the new Kharkhoda greenfield plant. The management attributed the lower margin to temporary factors and highlighted cost reduction efforts and higher non-operating capital and higher non-operating income as partial offsets. Looking ahead, Maruti plans to ramp up capacity at Kharkhoda and expand its EV ecosystem, including battery and charging infrastructure. These investments will be funded mainly through internal accruals. At the current levels, the stock trades at a PE of above 35, in line with its 5-year median multiple of 35 times. Fourth on our list is Mahindra & Mahindra. Mahindra & Mahindra is a diversified automobile and farm equipment major with leadership in SUVs and tractors. The company continues to benefit from its wide product portfolio, strong brand recall, and ongoing focus on electric mobility. The stock has gained around 30% in the past year as investors cheered its steady earnings growth and EV expansion. At a price of roughly 3,600 rupees and a face value of rupees 5, M&M is among the few large auto stocks where investors see room for a potential stock split to improve liquidity. The last split occurred in 2010 when the face value was reduced from 10 rupees to 5 rupees, and the steep rally since has reignited speculation about another. In Q1 of FY26, consolidated revenue rose 22% year-on-year, driven by a 22% increase in SUV volumes and 10% growth in tractors. The auto business maintained a 10% margin, while the farm segment achieved a 19.8% profit before interest and tax margin, reflecting healthy demand and cost discipline. The company's consolidated profit grew 24% and return on equity crossed 18% for the first time, supported by robust performance across group companies. Looking ahead, M&M plans capex of about 4.6 billion rupees in FY25, focused on product development and EV launches, including its new BE and XEV range. These investments are being funded through internal accruals. With the stock trading above its long-term median valuation and a strong momentum in both auto and farm businesses, Mahindra & Mahindra could emerge as one of the key large-cap candidates to consider a stock split in 2026. Presently, the stock trades at about 32 times, a premium to its 5-year median PE of 27. Last on our list is Hitachi Energy India. Hitachi Energy India supplies advanced grid, automation and electrification solutions that power industries, railways, and renewable projects. The company has played a key role in strengthening India's transmission and energy infrastructure for more than 7 decades. The stock has been one of the standout gainers in the power equipment space, rising about 22% over the past year. At a market price near 16,400 rupees and a face value of rupees 2, the high absolute price has raised the possibility of a stock split to make the shares more affordable to retail investors. The company has not undertaken a split since its listing under the Hitachi brand in 2020, when it was renamed from ABB Power Products and Systems India. In Q1 of FY26, the company reported 11% year-on-year growth in revenue, driven by strong execution in transmission and industrial projects. EBITDA improved on account of a better product mix, operational excellence, and timely completion of high-margin orders. Order inflows surged to an all-time high of 113.4 billion rupees, supported by major wins from Power Grid and Adani Energy Solutions for large-scale transformer and HVDC projects. Looking ahead, Hitachi Energy plans to expand manufacturing capacity for power transformers, grid automation, and service businesses. It is also investing in localizing its Grid E-Expand and Grid E-Motion product lines, with funding largely through internal accruals. The company's record order book of 291.3 billion rupees provides strong visibility. At current levels, the stock trades at a price-to-book value of 17.8 times, a premium to its 5-year median multiple of 15 times. Given its high valuation, sustained growth, and face value of rupees 2, Hitachi Energy could be among the top engineering names to consider a stock split in 2026. Even in a richly valued market, it pays to look beyond momentum and focus on fundamentals. Stock splits may draw attention, but it is the underlying business strength that sustains value over time. Investors should see a split not as a reason to chase prices, but as a reminder to revisit a company's earnings visibility, cash flows, and governance standards. The coming year could bring more companies to consider this step as their share prices climb to record levels. Yet the principle remains the same. Quality business with strong balance sheets and disciplined capital allocation continue to drive long-term wealth. In a market where valuations leave little room for comfort, being selective matters more than ever. That's it for today. Don't forget to like this video and share it with your friends and family and make them as smart as you are. This is Zil from Equitymaster. Thanks for tuning in.